Ray Dalio just called everyone keeping money in savings accounts stupid. And here's the scary part. He's actually right. The founder of the world's largest hedge fund managing over $150 billion has been warning investors for years about one massive mistake that's quietly destroying wealth. And most people are still making this mistake every single day. The problem is simple. While everyone thinks cash is the safest place to park money, it's actually one of the worst assets anyone can own right now. Let me explain why. Back in January 2020, at the World Economic Forum in Davos, Switzerland, Ray Dalio stood in front of the world's business and political elite and made a bold declaration that shocked everyone in attendance. He said, "Cash is trash. Get out of cash. There's still a lot of money in cash." At the time, people thought he was crazy. A few weeks later, COVID hit, and the market dropped over 30% in just 4 weeks. But here's the thing. Dalio wasn't talking about timing the market. He was talking about a fundamental truth about money that most people don't understand. To understand why Dalio hates cash so much, we need to look at history. If someone took $1 back in 1801 and just held on to it as cash until today, that dollar would be worth only 6 cents in purchasing power. But if that same person invested that dollar in stocks, it would be worth about $1.5 million today. That's not a typo, the same dollar. One strategy made it worth 6 cents. The other made it worth $1.5 million. But it gets worse for cash holders. Since the United States abandoned the gold standard in 1971, the purchasing power of the dollar has declined by 90%. Think about what that means. If your grandparents put $10,000 in a savings account in 1971 and never touched it, that money today would only buy what $1,000 could buy back then. They would have lost 90% of their wealth by doing what most people think is the safe thing. This is exactly what Dalio means when he calls cash trash. It's not that cash has no purpose, it's that cash loses value every single year due to inflation. And in recent years, this problem has gotten much worse. After the 2008 financial crisis, and especially after COVID, central banks around the world printed massive amounts of money. More money chasing the same goods means inflation. And inflation means the cash sitting in bank accounts is losing purchasing power faster than ever before. Dalio explained this perfectly when he said that governments are going to print money, so cash is not going to be good. He wasn't making a prediction. He was stating what always happens throughout history. When governments have too much debt and not enough money to pay for it, they print more money. And when they print more money, each dollar becomes worth less. It's basic economics. But somehow, most people miss it. Now let's get into Dalio's first rule for what to do instead of holding cash. This is the foundation of everything he teaches about investing. Dalio says you need to be globally diversified across at least 15 uncorrelated assets. Not 3 assets, not 5 assets, at least 15 assets that don't move together. Most people think they're diversified because they own a few different stocks or maybe some stocks and bonds. But Dalio proved mathematically that this isn't real diversification. Here's what he discovered. If someone holds 2 assets that each have 10% volatility, but they're perfectly correlated, meaning they move together, the portfolio still has 10% volatility. But if those 2 assets are uncorrelated, meaning they move independently, the volatility drops to around 7%. Add a third uncorrelated asset and it drops even more. Dalio found that by holding 15 to 20 good uncorrelated return streams, investors can reduce portfolio risk by 80% without sacrificing expected returns. Let me repeat that because it's incredibly important. An 80% risk reduction without giving up returns. That's not done by hedging or cutting exposure. It's done by combining assets that move differently from each other. This is why during the 2008 financial crisis, most traditional portfolios dropped over 30%, but Bridgewater's pure alpha strategy was actually up 9%. They weren't just diversified. They held assets that moved in opposite directions during times of crisis. When stocks crashed, their bonds and gold positions went up. When one thing failed, something else succeeded. The key word here is uncorrelated. Most investors think they're diversified because they hold stocks from the United States, Europe, and emerging markets. But when crises hit, like in 2008 or 2020, all those stocks tend to move in the same direction. They all go down together. That's not diversification. That's just owning different versions of the same bet. Real diversification means owning things that genuinely behave differently. Stocks perform well during economic growth with low inflation. Long-term bonds do well when growth and inflation are both declining. Gold shines during inflation spikes and currency debasement. Commodities protect against supply shocks. Each asset class responds to different economic conditions. Dalio created what he calls the all-weather portfolio based on this principle. The traditional allocation is 30% in stocks, 40% in long-term bonds, 15% in intermediate bonds, 7.5% in gold, and 7.5% in other commodities. This isn't about maximizing returns in bull markets. It's about creating a portfolio that performs reasonably well in all economic environments. Rising growth, falling growth, rising inflation, falling inflation. The math behind this is powerful. In a traditional 60-40 portfolio with 60% stocks and 40% bonds, about 90% of the volatility comes from stocks, even though only 60% of the capital is in equities. That's not balance. That's an equity portfolio with a bond sidecar. Dalio's approach balances risk across asset classes instead of just splitting capital. This is called risk parity. From 1996 to 2020, the all-weather portfolio delivered an average annual return of 9.7% compared to 7.6% for the S&P 500. But here's what matters more. It did this with much lower volatility and much smaller drawdowns during crashes. The goal isn't to beat the market in good times. The goal is to survive bad times and still make good returns over decades. The bottom line is that Dalio's first rule destroys the idea that cash is safe. Cash isn't diversified. Cash only does one thing: lose value to inflation. By spreading money across 15 or more uncorrelated assets, investors protect themselves from any single scenario destroying their wealth. No matter what happens in the economy, something in the portfolio will do well. Dalio's second rule takes diversification a step further. He says investors need to own hard assets that governments cannot devalue by printing more money. The two main hard assets he recommends are gold and, increasingly, Bitcoin. Let's start with gold because Dalio has been talking about this for decades. In October 2025, at the Greenwich Economic Forum, with gold prices hitting all-time highs above $4,000 per ounce, Dalio recommended that investors allocate around 15% of their portfolios to gold. That's a huge number compared to conventional advice. Most financial advisors suggest 5% or less in gold. Dalio is saying 15%. Why is he so bullish on gold? Because gold is the only asset that doesn't depend on someone else's promise. Every other financial asset is someone else's liability. Stocks are claims on company earnings. Bonds are promises by governments or corporations to pay back debt. Even money in a bank account is just the bank's promise to give back that money. But gold is gold. It's not anyone's liability. It doesn't depend on any institution or government. Dalio explains that gold is the second largest reserve currency held by central banks worldwide. Countries around the world are buying gold and reducing their holdings of U.S. treasuries and other government bonds. This isn't random. They're doing this because they're worried about the same thing Dalio warns about: currency debasement. The United States now has over $38 trillion in national debt. That number keeps growing. During fiscal year 2025, the government ran a budget deficit of $1.8 trillion. That means they spent $1.8 trillion more than they collected in taxes. How do they make up the difference? They borrow money by issuing bonds. But at some point, there aren't enough buyers for all those bonds at reasonable interest rates. So what happens? The Federal Reserve steps in and essentially prints money to buy the bonds. This is exactly what happened after 2008 and again after COVID. The Fed's balance sheet exploded from less than $1 trillion before 2008 to over $8 trillion at its peak. That's 8 times more money created out of thin air. And when more money gets created, each dollar becomes worth less. Inflation is just another word for currency devaluation. Dalio compares today's economic environment to the early 1970s. Back then, inflation was rising, government spending was heavy, and debt loads were high. People lost confidence in paper assets and fiat currencies. Gold prices surged from $35 per ounce in 1971 to over $800 by 1980. That's more than a 20 times increase. And it happened because the dollar was losing value and people needed something real to protect their wealth. The same dynamics are playing out today. Dalio worries that central banks have lost the ability to stimulate the economy the way they used to. Interest rates are already at historic lows in many places. They can't cut rates much more. So the only tool left is to print more money. And when governments print money to fund their deficits, gold becomes more valuable because it's one of the few things they can't print. Dalio puts it simply, gold has the best track record of tracking the cost of living over very long periods of time. It's maintained its purchasing power for thousands of years, while every paper currency in history has eventually failed or been devalued. The Roman denarius, the German mark, the Argentine peso, all destroyed by governments printing too much. Gold survived all of them. But here's something interesting. Dalio has recently added Bitcoin to his list of hard assets alongside gold. This is a big change. Back in 2020, he was skeptical of Bitcoin. He said it wasn't effective as a medium of exchange or a store of wealth. But by 2025, his view evolved dramatically. He now recommends putting about 15% of a portfolio into gold or Bitcoin combined. Why the change? Because Dalio recognizes that Bitcoin has something similar to gold: scarcity. There will only ever be 21 million Bitcoins. No government can print more. No central bank can inflate the supply. It's mathematically limited by code. In a world where governments are printing trillions of dollars, euros, yen, and yuan, Bitcoin's fixed supply makes it valuable as a store of wealth. Dalio still prefers gold over Bitcoin for most investors because gold has a 5,000-year track record and is held by central banks worldwide. But he acknowledges that Bitcoin serves a similar purpose: protecting wealth from currency debasement. For younger investors who understand the technology and can handle the volatility, Bitcoin might make sense as part of that hard asset allocation. The key insight from Dalio's second rule is this: in an environment where governments have massive debts and are printing money to pay for them, paper assets backed by those same governments are risky. Cash is the worst offender because it's guaranteed to lose value. Bonds aren't much better because they're promises from the same governments that are devaluing the currency. Hard assets like gold and Bitcoin can't be printed or devalued by decree. That's why they belong in every portfolio. Now we get to Dalio's third rule, which is less about what to own and more about how to manage a portfolio over time. He says investors need to rebalance strategically to take advantage of extreme moves in markets. Here's how this works. Remember that all-weather portfolio with 30% stocks, 40% long-term bonds, 15% intermediate bonds, and 7.5% each in gold and commodities? Over time, as markets move, those percentages will drift. If stocks have a great year, maybe they grow from 30% to 40% of the portfolio. If bonds have a bad year, maybe they shrink from 40% to 30%. Most people would just let this ride. They'd think, great, my stocks are doing well, let them run. But Dalio says that's a mistake. When percentages drift too far from the targets, the portfolio becomes unbalanced. It's no longer diversified the way it should be. And more importantly, it means some assets have become expensive while others have become cheap. This is where rebalancing comes in. Once or twice a year, Dalio recommends selling some of the assets that have gone up and buying more of the assets that have gone down. This forces investors to sell high and buy low, which is exactly what everyone says they want to do, but most people never actually do. There's a deeper principle here that Dalio calls paradigm shifts. He says extreme moves in markets and economies are largely self-correcting. When prices get extremely high, that attracts new competitors or people find substitutes. When prices get extremely low, supply dries up until prices recover. there's a lag between the extreme and the reversal, which causes big overshoots in one direction followed by big moves back the other way. By rebalancing, investors are betting on mean reversion. They're betting that what's up a lot will come back down, and what's down a lot will eventually recover. This doesn't work for individual companies, which can go bankrupt. But it does work for broad asset classes like stocks, bonds, gold, and commodities. The math behind rebalancing is powerful. If an investor has alternating gains and losses of 50% without rebalancing, they actually lose money over time. A 50% loss requires a 100% gain just to get back to even. The losses hurt more than the gains help. But if that investor rebalances after each move, selling winners and buying losers, the results improve dramatically because they're systematically buying low and selling high. Dalio also talks about something he calls rotating the portfolio. This is more active than simple rebalancing. It means taking profits on expensive stocks and reinvesting in undervalued stocks within the equity allocation. The idea is that markets go through cycles where some sectors or countries get overvalued while others get cheap. By rotating money from the expensive areas to the cheap areas, investors can capture better long-term returns. The key to making this work is having a disciplined process. It's not about predicting what will happen next. Dalio is very clear that nobody can consistently predict short-term market moves. Instead, it's about recognizing when something has moved to an extreme and mechanically doing the opposite of what feels comfortable. When stocks have crashed and everyone is panicking, rebalancing means buying more stocks. When stocks have surged and everyone is euphoric, rebalancing means selling some stocks. This feels terrible in the moment. Buying stocks during a crash feels like catching a falling knife. Selling stocks during a rally feels like missing out on gains. But over decades, this discipline is what produces superior risk-adjusted returns. Dalio's own track record proves this works. From 1975 through 2023, Bridgewater delivered net gains of $55.8 billion to investors. The Pure Alpha Fund had only 4 losing calendar years out of 32 years, from 1991 through 2023. That consistency came not from predicting every twist and turn, but from having a systematic approach to diversification and rebalancing. The third rule ties everything together. It's not enough to just buy 15 uncorrelated assets, including hard assets. Investors also need to maintain that diversification over time by rebalancing. Markets will try to push portfolios out of balance. The job is to push back against that by selling what's gotten expensive and buying what's gotten cheap. This is completely different from holding cash. Cash doesn't need rebalancing because it just sits there losing value. A diversified portfolio needs attention and discipline, but that attention creates value. It forces good investment behavior that most people can't stick to on their own. So here's the truth that Dalio has been trying to tell everyone for years. Holding cash isn't safe. It's guaranteed wealth destruction. Dalio's 3 rules work together to build real wealth protection. First, diversify globally across at least 15 uncorrelated assets so that something always works no matter what happens in the economy. Second, own hard assets like gold that can't be devalued when governments print money. And third, rebalance strategically to force buying low and selling high instead of chasing whatever's hot. These aren't complicated rules. They're actually simpler than what most people do, which is chase returns and panic during crashes. But simple doesn't mean easy. It takes discipline to spread money across 15 different things when one thing is doing great. It takes courage to own gold when it's not moving, and it takes guts to rebalance when it feels wrong. But this is exactly what separates successful long-term investors from everyone else. Cash feels safe because it doesn't move. But that stability is an illusion. Cash is slowly but surely being destroyed by inflation and government policy. The real safety comes from diversification, hard assets, and disciplined rebalancing. Dalio manages $150 billion using these exact principles. His all-weather portfolio has delivered consistent returns for decades through every kind of market environment. The financial crisis of 2008, the COVID crash of 2020, the inflation surge of 2022. Through all of it, the strategy worked because it was designed to work in all conditions. The choice is clear. Keep cash in the bank and watch inflation slowly eat away at purchasing power, or follow Dalio's 3 rules and build a portfolio that's actually designed to preserve and grow wealth no matter what happens next. One path leads to guaranteed losses, the other path leads to long-term success.